Hello, today we're going to talk about the GDP. GDP is an acronym that stands for Gross Domestic Product. This is a piece of statistic that provides two information at once, the total expenditure and the total income in an economy. The reason is that every transaction includes a buyer and a seller. If we assume that the buyer spends all his income and the seller sells all his goods and services, the expenditure of the first is the income of the second. On a larger scale, households spend money on goods and services produced by firms. With their revenue, firms pay the income of workers, landlords, and spend the net profit on other capital goods. A higher income means the possibility to afford more goods and services. Therefore, a higher GDP is considered the best measure of the economic well-being. A definition of GDP that focuses on expenditure helps to analyze how it's calculated. GDP is the market value of all final goods and services produced within a country during a certain period of time. Market values. To calculate the GDP, we simply have to multiply all goods produced by their various unit prices. Since prices reflect the willingness to pay, they measure their economic value. Of all, GDP includes all that enters into the marketplace. Therefore, goods and services produced at home or sold on illegal markets do not add up to the domestic product. Final. Only final products are part of the GDP. If a car manufacturer buys steel to produce a vehicle, the price of the steel is not included into the domestic product because steel is an intermediate good. It doesn't generate a revenue by itself, so its value is included in the price of the car sold. Goods and services. Also intangible services like a ticket for a movie are included into the domestic product. Produced. Sales of goods and services currently produced are into the GDP. Therefore, if I buy a used phone, the price of that phone is not included into the GDP. Within a country, the production must occur within the borders of a country. For example, if an American worker produces a smartphone in Japan, the device will account for the Japanese GDP. Conversely, goods produced by foreigners in the USA add up to the US GDP. And finally, GDP includes goods and services produced during a certain period of time. These numbers are quarterly reported in order to keep track of the nation's productivity and the prices level over time. Now that we saw how the GDP is measured, let's talk about its components. Gross domestic product is the sum of consumption, investments, government spending, and net exports. The consumption is the total expenditure of households on goods and services produced by firms. Investments is the total expenditure of firms on goods that will produce other goods in the future, called capitals. They divide in business capital, rent, and inventory. A good example of government purchases is the total amount spent on military assets and officers' wages. Social security payments are called transfer payments because they represent an income, but not a purchase of goods and services. Therefore, they are not part of the GDP. And finally, the net exports is the difference between the total exports and total imports. Exports are part of a nation's income, while imports represent an expenditure.
So in this part, I will be talking about what's real and what's nominal GDP. So nominal gross domestic product and real GDP both qualify the total value of all goods produced in a country in a year. However, real GDP is adjusted for inflation, while nominal GDP isn't. Thus, real GDP is almost always slightly lower than its equivalent nominal figure. In most circumstances, real GDP and real GDP per capita shows a more accurate picture of a country's economic performance since it can be more easily compared to past figures. Thus, we can deduce whether a country really is better or worse of year over year. As we can see from the table, it's shown the calculation between the nominal GDP and real GDP. And the nominal GDP, it's fixing its values, it's fixing its price according to the inflation. So price goes like $500, $520, and $600 for 2015, 2016, and 2017, while real GDP stays at the same price it's the base year. GDP deflator. GDP deflator, or the implicit price deflator, measures the changes in prices for all goods and services produced in an economy. GDP represents the total output of goods and services. However, as GDP rises and falls, the metric doesn't factor in the impact of inflation or rising the prices on its results. The GDP price deflator addresses this by showing the effect of price changes on GDP, first by establishing a base year, and second by comparing current prices to prices in base year. In economics, inflation is an increase in general prices level of goods and services in an economy. At this point, there is one question comes to mind, and the question is a GDP a good measurement of a well-being? As we know, GDP is important because it gives information about the size of economy, how an economy is performing. The growth rate of real GDP is often used as an indicator of the general health of the economy. In broad terms, we can say an increase in real GDP is interpreted as the sign that the economy is doing well. So, what it doesn't measure? At this point, we can say all the illegal activities and different stuffs, such as unpaid work, is not measured in the GDP. So, when we are talking about the GDP, there is also one interesting question that comes to the mind. So the question is how GDP influences people's standard of living. So GDP is an indicator of society's standard of living, but it is only a rough indicator because it does not directly account for leisure, environmental quality, levels of health and education, activities conducted outside the market, changes in inequality of income, increases in variety, increases in technology, or the positive or negative value that society may place on certain types of output. So the standard of living is all elements that affect people's happiness, whether these elements are bought and sold in the market or not. And in the end, I will be talking about the GDP per capita. GDP per capita is a global measure for gauging the prosperity of nations and is used by economists to analyze the prosperity of a country based on its economic growth. For example, USA and United Arab Emirates are developed countries. We just can determine that by just looking at their GDP per capita. But there are some cases that people using crime rates for measuring society's standards of living. In this case, using crime rate for measuring society's standards of living is irrelevant because USA crime rate is 49.48 out of 100, while United Arab Emirates crime rate is 16.24 out of 100. Despite the fact that both countries has higher GDP per capita, which is higher than the $44,000. Which proves the fact that using crime rates is not a key determinant in order to look society's standards of living. In conclusion, GDP per capita is a key determinant of measuring people's standards of living. Thanks.